Are we on the brink of a housing market crash similar to 2008? Well, if you're a home buyer or real estate investor, you might be wondering why the US housing market hasn't crashed yet, despite being massively overvalued. Homebuyer demand has plummeted, yet prices remain stubbornly high. Well, according to the National Association of Realtors, prices have only dipped by 1% year over year in June 2023, echoing the decline that we saw at the onset of the last downturn in 2006 and 2007. Well, many people believe that the housing market won't crash or worsen because it hasn't done it yet. However, I would urge caution. The housing market is currently overvalued by about 31% compared to America's income levels and 26% compared to rent levels. These overvaluations are even more extreme than those leading up to the last housing bubble, suggesting a significant downside risk for US home prices. There's another barrier preventing these price declines as well: low inventory. The National Association of Realtors report that single-family inventories is only around 950,000, about 50% below the long-term historical average. Now, this low inventory is propping up the prices in America's housing market, even causing them to rise past spring. However, this situation is not sustainable. Inventory is low due to stronger buyer demand, but because sellers are reluctant to list their homes, data from Redfin shows that new listings are down by about 25% from their long-term historical norm. Now, I believe that inventory will increase in the future, pushing prices down due to the prevalence of risky mortgages. Now, many American homeowners are currently house poor, barely managing their mortgage and property tax payments. These homeowners are at a high risk of selling in the future if the economic downturn worsens. Now, to understand this, consider the debt-to-income ratio for American homebuyers. The Federal Housing and Finance Administration report has reported that this ratio is nearing 40% on the US housing market. This means that the average home buyer is spending close to 40% of their gross income on their mortgage interest costs, thus the term, right, being house poor. So this is a concern. It's very concerning because it's a higher level of mortgage interest debt than people had in the run-up in the last bubble. Now, the debt-to-income ratios today are comparable to those in the mid-2000s, suggesting that we are likely to see mortgage defaults and foreclosures in the housing market during this cycle. Now, many people believe that we won't see these defaults or foreclosures because we no longer have bad or subprime loans, right? These bubble loans that would blow up. However, if the debt-to-income ratio today are the same as they were during the mid-2000s, a down payment levels are actually lower than they were then we're likely to see a wave of inventory of they're going to have to sell. There'll be forced selling in the housing market at some point in the, I would say, near future. So these factors are really interesting with a significant drop in home buyer demand. Now, mortgage purchases or mortgage purchase applications and home sales are near their lowest levels in 2 decades. June home sales were 19% lower than they were last year, the slowest pace we've seen since June of 2009. This low demand is due to poor affordability metrics in the US housing market. Now, the housing market is 30% overvalued compared to income and rents. And when you factor in a 7% mortgage rate, most homeowner buyers simply can't afford to purchase that home. For instance, a good example is in Florida. The median household would have to spend 45% of their income on a house to afford it. In California, the typical house payment is 62% of the median household income. This poor affordability means that even when inventory increases, there won't be enough buyers to meet the demand because you simply just can't afford it. This is a problem for many people in the housing market, particularly realtors. Low levels of home sales and the beginning of price declines has significant reduced realtor income as well, right? So if you're a realtor, you're going to be impacted by this. As a result, many realtors are also leaving the market. So if you're a home buyer and you need to decide what your risk tolerance is and whether you can afford to buy a house at today's mortgage rates and prices, or if you're an investor, you should focus probably more on higher yield markets with more security, safety, and capital preservation qualities. If you're a realtor, though, you probably need to be looking at a different job, right? There's already has been a surplus in realtors, particularly the amount of demand in finding new listings has dropped significantly. So wrapping things up, the housing market is still tremendously overvalued, and it's a risky proposition to buy a house today. However, the housing market is not like the stock market. You're not going to see drops like 30 and 40% in a year or 6 months to fix this. It's going to take significant amounts of time, both from the home sellers and the realtors, to kind of just wake up to this new reality of this downturn that we're in. It's also important to note that historically, the housing downturn takes 5 years from start to finish. And this reality probably is very uncomfortable for most people to accept because it suggests that we're not going to see immediate relief in the near future. So it's going to be an incremental process. If you guys found that this video was helpful, obviously feel free to share with your friends. To stay tuned with what's happening in the real estate market, you're welcome to follow me on my Market Pulse podcast. I specifically do a real estate focus every second Friday. You can also like, follow, or subscribe to stay just with us in this journey as the housing market kind of starts to unfold this new territory. Until next time, thank you.